This is a relatively short video on materiality. One of the reasons I want to present this video separately from the rest of our presentations is because the concept of materiality is extremely important to the auditor and the audit process. As a matter of fact, it's probably the most single important concept to the auditor and the audit process. As a matter of fact, it impacts the auditor in audit planning, during the execution of the audit, and also through the issuance of the audit report. So we're going to spend some time on talking about materiality. Now, before we go on into materiality, let's work on a basis. Okay, if there's a number of different auditing standards that refer to materiality and also to forming opinions on the financial statements, the independent auditor's report, I'm going to refer to one standard in particular, which is AUC 700. And what it says is the auditor should form an opinion on whether the financial statements are presented fairly in all material respects in accordance with the applicable financial reporting framework. So let's break down material into the term materiality here. And we can see materiality is the significance, in other words, the importance of information or the omission of information in the financial statements. And remember that not only includes the balance sheet, income statement, statement of cash flows, but that includes all the notes to the financial statements. So materiality is basically what it's saying is if something is material, that means it's important to the users of the financial statements, or its inclusion or its omission. So with that, again, let's talk about how materiality impacts the audit process. Okay, first of all, again, I'm going to follow up by saying materiality is the significance of information or the omission of information in the financial statements. And what we see here is materiality impacts the entire audit process. So we're going to take a look at the different audit phases. That includes audit planning, obtaining an understanding of the client and its environment, assessing risks of misstatement and then designing further other procedures, performing tests of internal controls, performing substantive procedures, completing the audit, and then issuing the audit report. And what we can see is right in the beginning during audit planning, it is the auditor's responsibility to establish materiality. In other words, what's important to the users on the financial statements. Now that also implies there's other things on the financial statements that may not be as important. Now, in planning materiality, and this is what we're talking about right here, during the planning phase, the auditor makes judgments, and that's a key term right there, makes judgments. In other words, the auditor has to rely upon their professional judgment about the size of misstatements, and I also add the size and nature of misstatements that will be considered material. These judgments provide a basis for determining the nature and the extent of the risk assessment procedures. Obviously, materiality sets the stage for assessing risks. B, identifying and assessing the risks of material misstatement, and C, determining the nature, timing, and extent of further audit procedures. So materiality drives all of these steps through through the planning process and all the planning. Now, what will happen is that as we go through the steps of the audit process, what's going to happen is that uh, we will uh, we will take into consideration materiality in everything that we do. And as we go through these audit phases, we learn more and more about the client or what's going on currently with the client. And audit standards specifically state that we may revise or may have to revise materiality as necessary based upon the information that we're gaining during the audit. So if we find out that there's additional impact of materiality in the financial statements, we may have to go back and revise all of these planning items that we've just gone through during the planning, even though we're halfway through an audit. So it's very important we understand that we may, as auditors, have to exercise professional judgment during the audit and revise materiality. Now, revision can go both ways. Remember that. Now, during the audit phase, when we're starting to assess risks of misstatement and we start performing our tests and so forth, based upon the materiality levels that we have established, we will identify misstatements and have the client or ask the client to correct any items that will impact established materiality. Remember, we as auditors do not make entries into the client's records. The only thing we can do is we can request that the client make those adjustments. These are the records of the company. They are owned by the company, and the auditor has no business making adjustments, only recommending those adjustments. Now, if they don't make those adjustments and they are material, those type of uncorrected adjustments are with consequence, because when we're talking about issuing the audit report, if we have uncorrected misstatements that are material, they may affect the audit opinion. We may have to issue some form of modified opinion or adverse opinion, or possibly a disclaimer, depending upon the individual circumstances. We'll get into that further in our course. So again, this is an illustration that materiality, the concept of materiality, is pervasive through the entire audit process. Now let's go on and come up with a little bit more of a definition about materiality that is found in the audit standards. Now, materiality includes misstatements, in other words, some type of quantitative error. So includes misstatements and omissions, in other words, a lack of information that could be material, that individually or in the aggregate could reasonably be expected to influence the economic decisions of users. In other words, those items where if you have a misstatement or an omission of information, that misstatement or the omission could affect the economic decisions of the users, make it what they made on the basis of the financial statements. Now, the standards go on further to say about materiality, judgments about materiality, and there we go again, judgments, the auditor's professional judgment, are affected by the size, in other words, the amount that we're talking about, of the amount of the misstatement or omission, and or nature of the misstatement. We'll talk about what nature of the misstatement means in just a few minutes. So we're talking about size, the dollar amount, and the nature of the misstatement. Also, based upon a consideration of the common financial information needs of users as a group. That's what we basically have to make our judgments about. Now, it goes on to say the possible effect of misstatements on individual users whose needs may vary widely. We really can't consider that because we can't meet everybody's needs for materiality. We have to basically meet the common needs of the users. Now, here's where we're talking about nature of the misstatement or omission. Magnitude by itself, without regard to the nature of the item and the circumstances in which the judgment has to be made, will not, again, emphasize, will not generally be a sufficient basis for a materiality judgment. In other words, even though an item falls below what the auditor considers to be a materiality threshold, we have to look at why a particular misstatement or omission was made. In other words, what is the intent of the client? And what happens here is that the SEC and the AICPA provides some examples. Such consideration may include, but not be limited to, and again, remember, these could be immaterial. However, if the auditor notices this is what's going on, these items could rise to the level of materiality, even though they're not at the materiality dollar thresholds. Making a change in earnings or other trends. Hiding a failure to meet analysts' consensus or expectations for the enterprise. Changing the loss into income or vice versa. Concealing a segment or other portion of the registrant's business that have been identified as concerning a significant or other portion of the registrant's business that has been identified as playing a significant role in the registrant's operations or profitability. And you probably understand when I'm saying the word registrant, that is a term that the SEC uses, anybody who registers under the SEC. This is also equally applicable to basically a non-registered client with the AICPA standards, the AUCs. Okay, also affecting the registrant's compliance with regulatory requirements, affecting compliance with loan covenants, concealing an unlawful transaction, and increasing management compensation. So I think by looking at these, you kind of get the gist of what they're trying to get at. Is if it looks like the management is trying to manipulate certain information in the financial records, these items could lead the auditor to consider that a material misstatement, even if those items fall below the threshold, the dollar threshold for materiality. Now let's talk about materiality in general. The first thing we're going to talk about is planning materiality. Now, before we do that, what I want to point out again is, and I've talked about this, I think, in our second slide, planning or performance materiality, and we'll talk about what performance materiality is in a few minutes, is established during the planning process, which we talked about in slide number 2. And again, remember, it may be revised anytime during the audit based upon the information the auditors gathered. In other words, the auditor, once they do the plan, doesn't mean that everything sits in a static environment. If the auditor decides they have to have there's a reason to change materiality, the auditor will have to do, or the auditor is required by audit standards to do that. Now, what is planning materiality? And that's a specific term under audit standards. Audit standards, it includes misstatements and omissions that individually or in the aggregate could reasonably be expected to influence the economic decisions of users made on the basis of the financial statements. Now, remember, Typically, when we're talking about planning materiality, we're probably trying to set up a dollar level. So it's basically planning materiality is pretty much quantitative. However, we have to remember in even when we're doing our planning materiality, we also have to state in our plan the fact that the even though the dollar amounts may not hit a materiality level, the intent of the transactions may raise them to the level of materiality. Now, how do I set materiality? Simply by saying some criteria, a dollar amount. In other words, a misstatement of $50,000 is material, or a omission of $50,000 is material. Now, we'll talk more about that as we go along, but planning materiality normally does set a quantitative value. Now, we go back again and we look at planning materiality, and I repeat here is that planning materiality is established at the beginning and be changed any time. Now, how does the auditor actually establish planning materiality? Okay, it's established upon the auditor's professional judgment using appropriate benchmarks. Well, what are the appropriate benchmarks? It's whatever the auditor decides within their professional judgment. Now, the audit literature provides several different examples relating to benchmarks. And they're saying the auditor could create a level of materiality based upon the percentage of the absolute amount of elements of the financial statements. For example, percentage of assets, percentage of liabilities, equity, revenue, or expenses. So let me illustrate this. Now I'm going to use my mouse here to do the illustration. But let's assume the auditor in their professional judgments decides to state that what will be material they feel to the user of this financial statement will be any adjustment that exceeds 5% of the net assets of the company. Let's assume right now the net assets of the company are equal to, and again, forgive me using this mouse, but I'm going to try to draw it in. The percentage of, or the net assets are $1 million. So I'm going to put in $1 million. And the auditor's saying is any adjustments in excess of, as I said, 5% of my net assets are going to be considered material. So what that means is when I do the computation, that means I'm going to come out to $50,000. And it's saying that any misstatements or omissions that rise above $50,000 or that aggregate greater than $50,000 will be considered material. And again, we would request that the client make those adjustments. If they don't make those adjustments later on down the line, that could definitely impact the auditor's opinion on the financial statements. Now, that's one type of benchmark, and I provided an illustration. Okay, also, the auditor may establish materiality benchmarks, or a benchmark where items exist on which the attention of users of a particular entity's financial statements tend to be focused. As an example, if the users are focused on accounts receivable, materiality may be devoted to certain levels of accounts receivable. Also, the nature of the entity, where the entity is in its life cycle, and the industry and economic environment in which the entity operates. Number 4, the entity's ownership structure and the way it's financed. And number 5, the relative volatility of the benchmark. Now, these are not the only benchmarks, but these are the types of benchmarks that the auditor that they give examples of the auditor to consider. The auditor can use many other type of benchmarks within their professional judgment in which they feel is applicable or is important to the user's financial statements. Now, I will tell you, I think, and you probably already know intuitively, that the most common method of a benchmark is basically some form of percentage of the financial statement information. Doesn't have to be, but that's the most common. So we've just talked about planning materiality. Now we're going to talk about another type of materiality that is mentioned in the audit literature, and it's called performance materiality. Okay, performance materiality is different than planning materiality. Now, if we look at the literature, performance materiality is defined under the AICPA audit standards. The PCAOB also similar has similar standards. However, the PCAOB calls performance materiality tolerable misstatement. So in the AICPA calls it performance materiality, while the PCAOB calls this same concept a tolerable misstatement. Now again, just like planning materiality, performance materiality is established during the audit planning process. And performance may, just like the planning materiality, performance materiality may be revised anytime during the audit based upon the information that the auditor's obtaining during the audit process, during the audit phases. Now let's talk about the definition of performance materiality. And this comes right out of the standards. The amount or amounts, again, we're talking about amounts set by the auditor at less than the materiality for the financial statements as a whole. Now, let me stop right there. The amount or amounts set by the auditor at less than materiality for financial statements as a whole. Now, what that really means is the amount or amounts set by the auditor at less than planning materiality. So what they're saying here is that basically the amount or amounts set by the auditor at less than planning materiality for the financial statements as a whole. Now, the reason we do this is to, let me do another color, is to reduce to an appropriately low level the probability that the aggregate of uncorrected and undetected misstatements exceeds materiality for the financial statements as a whole. Now, that can be kind of confusing. So that definition. So what I'm going to do is skip this paragraph just for a moment, and we're going to go down to this middle box here and look at this. We're going to explain performance materiality. So performance materiality recognizes the fact, and let me erase that, I made a mistake. Recognizes, those markings are too low. Performance materiality recognizes the fact that errors and omissions detected in a particular area may not breach the overall materiality level, but when all the errors and omissions in all areas are combined or added together, the overall materiality could be breached. Now, I'm going to skip the next paragraph and go down to the next box, and we're going to do an example here. Here's an example of performance materiality. Assume the planning materiality level is set at $100,000. So we set the threshold for misstatements to basically be $100,000 or more each. Now assume that during the audit, a misstatement in accounts receivable was noted for $50,000. That's clearly below the $100,000 level. We also notice a misstatement in inventory was noted for $40,000. Still clearly below the $100,000 level. And a misstatement in plant and equipment of $45,000 was noted, again clearly below the $100,000 level. Okay, no one single misstatement would equal the materiality level, but all three misstatements aggregated would exceed the materiality level. In other words, the 50,000 plus the 40,000 plus the 45,000 would aggregate to greater than $100,000. But if we set the materiality level at $100,000 and looked at every transaction based upon that, none of these transactions would be recognized at all. So what we do is we're going to set the amount basically of performance materiality at less than the materiality level for the financial statements. So what we're going to do is we're going to set, as an example, performance materiality. Let's say we're going to set that at, for each account, we're going to set the account for accounts receivable, we're going to set it at, let's say, $30,000. So anytime we have a misstatement in accounts receivable that's greater than $30,000, we would pick up that misstatement of $50,000. Let's assume we had a $30,000 basically performance materiality for inventory. We would pick up that amount, $40,000 misstatement. And let's assume we had a $30,000 misstatement or a level performance materiality for plant and equipment. Again, we'd pick up the $45,000 misstatement. When we aggregate all those together, those exceed the tolerable, or in effect, the misstatement level for the financial statements as a whole. Now let's go back. So that's what we're talking about. What we're doing is we're setting the performance materiality at a lower level, so we will actually end up selecting misstatements that are normally significantly smaller than the planning materiality for possible aggregation. Now, let me go on here. Now, performance materiality can be set at different amounts, and that's important, at different amounts. And the reason that let me go on, can be set at different amounts based upon whether we're looking at transactions, account balances, or financial statement type of disclosures. So we can set our performance materiality as an example. If we go back down here, we can set our accounts receivable performance materiality for 25,000. We can set our performance materiality for inventory, let's say 30,000, and we can set plant and equipment at, let's say, 40,000. It depends upon how we feel in terms of the risk associated with a misstatement in that account. And that's what we say here. Can be set at different amounts based upon the transaction account balance and financial statement disclosure assertion levels, depending upon the auditor's assessment of misstatement from past or present experience and the characteristics of the transactions. So unlike planning materiality, which is a single amount for the financial statements, we can set performance materiality at different levels. As an example, if we are not too sure as auditors about accounts receivable, that we think there's a higher risk of misstatement there, what we can do is we can set the performance materiality at a low threshold. If we look at plant, property, and equipment and we see there's literally not been one change from year to year, it's probably a very, very low risk type of area. And we can set the planning material, or say the performance materiality, to a very high threshold because the chances of an error are very limited. Now let me go to this next paragraph that we didn't go through, that we omitted right here. We can adjust performance materiality, which I was just talking about, to an appropriate balance. And let me go back with the eraser again because I drew through everything. Okay, we'll go back to, we can adjust performance materiality to an appropriate balance or transaction level that corresponds to potential riskiness of the account transaction. And that's what I've just talked about. And think about this from a planning standpoint. For accounts where more risk exists, in other words, we're not too sure about those accounts. We think there's more risk there. We're probably going to lower the performance materiality threshold. For accounts where less risk exists, we may increase a performance materiality threshold, but again, it's still going to be below the planning materiality. So the more risk an account has, we're going to lower that performance materiality threshold, and the less risk it has, we're going to take a little more chance with that. So that's performance materiality. Now, we talked about just a few minutes ago about performance materiality, and again, the literature, the accounting standards talk about when performance materiality, when it should be adjusted. And what they say within the literature, it says factors within a disclosure, balance, or series of transactions that could cause an auditor to use a lower threshold for performance materiality include, but are not limited to, the high risk of misstatement within the account balance, or the class of transactions, or the disclosures. So again, if depending upon what we're examining, if we find out, if it's our opinion as auditors, we have a high risk in those areas, what we're going to do is we're going to lower the threshold for materiality in those particular areas. And that's what all these other suggestions relate to. Increased number of accounting issues. It requires significant judgment and or more estimates with high estimation uncertainty. So again, we're going to lower the performance materiality in those areas. A history of material weaknesses, significant deficiencies, or a high number of deficiencies in internal control, or maybe there was fraud in the account. Again, we want to lower the threshold. High turnover of senior management or key financial reporting personnel, and there could be issues with the methodology that the auditor is going to be using for testing, so we may want to change materiality levels based upon that. And when I say materiality levels, again, let me reiterate performance materiality.